Good evening, everybody. Sorry for the delay. Still downloading on Omnovia. Tonight we've got the great pleasure of having Mark Sebastian back. He's a former member of the Chicago Board of Options Exchange, as well as the American Stock Exchange. He's also been the author of the popular trading manual, the Option Traders Hedge Fund. So you probably have seen him. He's a frequent guest on CNBC, Fox Business News, Bloomberg. So he's got some very good techniques for trading the volatilities of the market. So with that, Mark, welcome again to the Candlestick Forum. We're anxious to see your information tonight.
Thanks for having me, Steve. It's always a blast being here with your group because you've got such a great, smart trader. So I love giving information to a group of smart people because they just absorb it like it's like it's coffee, like it's caffeine. So today we're going to talk about trading VIX options, hedging, and trading strategies. Before we start, just be aware that this is for education. It is not meant to be any type of advisory, any forward-looking statement. Anything you hear out of this, consult your advisor. And now look at that handsome guy. That's me. I'm Mark Sebastian. I was a trader on the floor for about 10 years. Since then, I've started Option Pit, which is an education and consulting business. We work with individual investors and large institutions. We work with institutions that are as big as about $15 billion, and we'll work with someone as little as $1,500. Scary thing is usually the person with $1,500 probably knows a lot more about options than the $15 billion manager. In addition, we are in the middle of launching a hedge fund, and we do a few other things here and there, but that's us in a nutshell. So now let's talk about what you're going to learn today. We're going to talk about what is volatility, what is the VIX, what are VIX options and futures, what causes VIX options to move, ways to trade VIX, and ways to use VIX to hedge. It certainly has been in the news as of late. All right, so volatility. Volatility is a measure of movement of an underlying instrument over a period of time regardless of direction. All right, and there are many ways of looking at it. The higher the volatility, the higher the movement and or expected movement of the underlying. So basically, the higher the VIX is, they like to call it the fear index. It's more of just like how much is the market expecting the S&P 500 to move? When it got up to 40, yes, we had fear high, but we on top of a 70-point sell-off, we also within a week saw a 70-point sell-off. So volatility is kind of really the key to all of this stuff. So when I discuss volatility, no matter how long the expiration, the number is always annualized. So a lot of people don't realize this. The VIX is like a 30-day volatility index, but I think it's settled around 24 today. It is an annualized number. So it is, it's an annualized number. So when we say the VIX is 25, what that says is that right now, options with 30 days to expiration are making a bet that the underlying, the S&P 500, is going to move 25% annualized, or, if it held this way, it would move 25% annualized. Now, it is relatively rare for the S&P to do that. And if it ends up doing that, the VIX is probably going to be higher than 25, but that's what the VIX kind of tries to say. All right, so there are three main types of volatility traders look at. Historical volatility is how much an underlying has moved in the past over a set number of days. And, I know traders that look at 3-day and, 100 days. All right. It's basically a moving average of how much the underlying has moved in the past. I know Steve is an expert on moving averages, so you guys, the idea of moving averages should be pretty easy to understand. Right? Realized volatility is how much an underlying is actually moving. Right? And implied volatility is how much the market is expecting an underlying to move over a set future time period. So when we talk about option volatility, that really means option implied volatility, and that is the market's best guess at how much an underlying is going to move. All right, so what makes implied volatility so different from the other? What makes trading volatility different over trading a stock is that over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the stock price is going to go. Apple could go to infinity. Its volatility will mean revert. Right? That's just the way it is. It absolutely will mean revert. And that's a major, all right, is that there's this mean reversion. I shut down Skype. That should take care of that. So take a look. This is a chart from a few months back of Apple. And it just looks like it's going straight up. And, if you look at the 50-day moving average and the 100-day moving average, it does not look like there's much of a real pattern there, at least, in the immediate. But then if I pull up VXAPL, now what is VXAPL? The CBOE actually puts out volatility indexes on 5 individual equities as well as a whole host of other names. So there's a VIX for gold, there's a VIX for oil, there's a VIX for crude WTI futures options, TLT, the exchange rate on euro to US, the 10-year note, you name it, there's a volatility index. And this one happens to be Apple, and it's the VIX calculation over Apple options. And what you notice is that, while there's a time where volatility absolutely gets cheap and volatility absolutely gets expensive, this is not one of the, if you give it enough time, so the gray bar is that 200-day moving average, it starts to really smooth out. And if I pull up like a 5-year average, a 5-year moving average or a 2-year moving average, that line, a 2-year moving average line or a 3-year moving average line would almost be flat. So the key to understand is that a stock price can go anywhere, but it won't stay there, and it can stay there. All right, it can go super high, but it can go anywhere. All right, it can explode, but it has to come back. So if you think about the VIX from the end of the late August period, in a day we saw the VIX go from 53 back below 30 in about 2 days. So if you understand that volatility can explode higher, but eventually can come back, then that's what really is the key to trading and understanding volatility and really VIX. So it can really help you with buy-sell decisions. And I use volatility in all of my buy-sell decisions. One of these times I want to take some of Steve's ridiculous indicators and then run them over a volatility indicator and see if we couldn't come up with something that would blow things out of the water. And so That's really the key. So most traders think mean reversion is an instantaneous thing. It is not. All right. Volatility can stay low or high for big periods of time. So vols can stay low for extended periods of time. If you really look at most, kind of the end of 2011, all the way through to basically June of this year, the VIX looked like it was going straight down. Volatility was low. And then in a flash, it can go sky high. We watched the VIX go from 13 to 26 to 53 in about a week. It doubled itself twice. Anybody here know a stock that can double itself twice in 4 days? I mean, legitimately, on Tuesday, the VIX was 13. And on Thursday, it was 18. On Friday, it was 26. And on Monday, it topped out at 53. That is something that doubles itself twice in about 4 days. Anybody think of a stock that did that? No, I can't either. And that's what makes trading volatility so interesting. So when IVs are low, they can stay there for a long time. All right? No, not in 4 days. So when IVs are low, they can stay there for a long time. Money can seem super easy. That's where premium sellers, I a lot of time handing Kleenex to premium sellers the last week of August. All right, because that's the easy money. But that money can go away incredibly fast. So the play is to be long vol, long units, and short premium when vols are really low. So when implied volatility is really, really cheap, you definitely want to be collecting premium. All right, that's the key. But you want to come up with some ways of being a net owner of options and being a net owner of Vega. So things that I like when the VIX is 13 or lower are things like calendar spreads. And I've got some cool butterfly trades that I will do when volatility is excessively low. And, so now when implied volatility is super high, okay, and yeah, actually shorting VXX can work really well, buying puts in VXX, buying puts in UVXY. That can be great when volatility is low. The old saying in volatility is, what's the old saying with stocks? You want to buy low and sell high, correct? Well, the key with volatility is you actually want to buy high. Does that make sense to everybody? Typically when something is expensive, it keeps getting more expensive. So the key with volatility is you want to buy high and sell higher, and you want to sell low and buy lower. So the key, and this can be kind of with stocks, right? When they're exploding higher, there can be a good trade in buying that stock, letting it run up, and then selling it out later. And when stocks are getting pounded, it can make more sense to short than to go long. Volatility really acts like kind of stocks like that. All right, so when IV is high, it will fall back. And until recently, spikes were short. All right, this one has not been. All right, this spike So can one still play directional option calls or puts when IV is high or just when IV is low? One can, but the game changes a little bit. You know, one of the problems with high volatility is what happens to the beta of all stocks. They tend to all correlate to the S&P 500. So one of the problems with playing directionally is that when implied volatility is really exploding, that typically that's when stocks correlate really closely to the S&P 500. So all your smart, let's buy this and sell that can be a little more difficult to trade. I'm sure many of you experienced that. You know, it becomes more of a play on the S&P 500 than a play on the stock itself. At least when volatility is truly exploding. All right. Ivy can stay high for months and take months to ease back. So when implied volatility is high, I like plays in long VXX, and I like short time spreads. Short butterflies can work. All right, and you know, short wings. Jay, that's a great question. Ask me that toward the end when I'm kind of through the discussion, because you might get your answer while I'm going through this. And if you don't, ask me later. All right, so now we're going to dig into the VIX now, and that's the SIBO Volatility Index. The purpose of the index is to gauge the buying and selling of options in the S&P 500. It's the cost of insurance. You know, how much does the market think things are crazy? You know, I liken a low volatility environment to writing insurance for a 44-year-old mother of 3 with a minivan and trading volatility when the VIX is high to writing insurance for a chain smoking, Camaro driving 16-year-old. You know, your Becky Oxford type, right? Becky, you're a chain smoking, Camaro driving, chain smoking 16-year-old. So, you know, that's a much tougher policy to write. And that's why it's more it costs more to insure your 16-year-old kid than it does you, unless you're a terrible driver. Is more buying than overselling, generally the market is trying to buy protection, VIX is up. When there's more selling than buying, the market is not out seeking protection, VIX is down. So when VIX up, cost of insurance is higher, and vice versa. So similar to the S&P 500, this index is not actually traded, and unlike the S&P 500, more buying of options. So Scott McKenzie says, I thought when there's more buying, market going up, then VIX goes down. What I mean is more buying of options, not more buying of stocks. So when there's more people out buying put options on the S&P 500, the VIX goes up. And when there's people selling put options, that's when the S&P 500 goes down. No, but that was a good question, because I bet you a lot of people maybe thought the same thing. So the VIX is essentially an estimate of implied volatility on S&P 500 that has a net duration of 30 days. So as a constant duration, that means that it tends to constantly mimic a portfolio of 30 days. And the crazy thing is there is no way to trade the VIX itself. Absolutely no way. All right, so you can do a basket, you can do S&P 500. On futures, you can do, on the S&P 500, you can do S&P futures, you can do a SPY, you can do a basket of stocks. Those all recreate the S&P 500. There is no way to do that in VIX. It is legitimately impossible to trade as a listed entity. So that's why really understanding what VIX options and futures are is key. So now, what causes VIX to move? All right, the weighting of the VIX puts puts more emphasis on at-the-money options, those trading near the underlying. All right. The weighting of the VIX naturally puts more emphasis on out-of-the-money puts than out-of-the-money calls. 30 days to expiration. So one is equal to or less than 30 days. The other is more than 30 days. So here's an example. All right. So in this chart, the VIX would use the one with 30 days to expire and the contract with 37 days. And the weighting would actually be 100% and 0. And then over a 7-day period, it would roll between the October 4/14s and the October 5/14s. So now here's the funny part. You know, you hear a lot of people quote the VIX as a price, but it is not. It is a percentage. Volatility, despite not being spoken as a percentage, percent is always a percent. So when the VIX is 30, it actually means 30% annualized volatility. So a 30% annualized expected movement over the next 30 days. All right, so now here's kind of the silliness. Anybody, you know, I'm a big baseball fan. My Cubbies are doing very well this year. Go Cubs. And use percentage in baseball. Well, you could say batting average or on base percentage. So when Anthony Rizzo, first baseman of the Chicago Cubs, when his batting average goes from, let's say, 300 to 330, do people say that his average is up 30 points or it's up 10%? Can you think of a single instance where somebody says, describe that gain as a percentage amount? No, it makes no sense. It means nothing. So when someone says the VIX is up 10%, it means nothing. And you can basically disregard their option knowledge because they probably don't know what they're talking about. So now, the red line, all right, is the S&P 500. The yellow line is the returns on the VIX. And what you notice is that the spikes up in returns on the VIX correspond with very rough times for the S&P 500. I'm going to give you another view that I think is maybe a little better. So the red line is the VIX, and you can see the VIX pricing is up here. The blue line is the S&P 500, and its pricing is on the left. So the blue line priced on the left, red line priced on the right. And yeah, you notice how those two really do not, they trade almost exactly the opposite of each other. The VIX is extremely negatively correlated with the S&P. Right? So when SPX is up, VIX is generally down. When SPX is down, VIX is generally up. This makes sense as generally when the market sells off, volatility does increase. All right, there's also the nature of similar movement against a lower number. So think about this. If a stock moves 10 bucks a day and is worth $100, it moves 10% a day. If that stock drops to 50 bucks, but is still moving 10% a day, but is still moving 10 bucks a day, well, it's now moving 40% a day instead of 10% a day. So its volatility is way higher. All right, and there are a couple other little features in VIX that can cause it to go up naturally. But when the market moved up 600, that is still big volatility, so it should have stayed up, and it did. You know, the market moved up 600 bucks, but the VIX still stayed well into the 20s. So it still said, hey, there's still problems here. Basically, it's pricing in a daily move of about 2%. That'd be 2% a day for the next 30 days. Think about that. So when the VIX gets it to 30, there is some serious all right. So the construction, because of this thing called volatility skew, where puts are more expensive than calls, it also gives VIX extra breath on a sell-off and causes it to compress on rallies. All right, so now, any questions on VIX, on how VIX works and how volatility works? All right, and because before I can get into trading them, there needs to be an understanding of how they work. Great. All right, so this is percent of time, 100% inversely. Often is the big, so the general inverse correlation is about 80%. So it has a negative correlation. It's got a beta of about negative 0.82. All right, so this is the VIX futures curve. And yeah, what type of curve is this called? All right, there's a name for the way this curve is structured. It's called contango, right, Bill? So this is called contango. And what contango means is that the cash market is cheaper than the next future, and that is cheaper than the next future, and that is cheaper than the next future. All right, and this market that I've got right here is a contangoed market, and it's from basically last year. All right, and this is the way the VIX is about 80% of the time. So 80% of the time, VIX futures are riding a slow wave of death. So if you think about it, if the VIX stays at 16.16 here, and I got long a May future for 1901, if the VIX just stays there, I'm going to lose $2.85 a contract. And you guys know what the multiplier is on VIX? It's 1,000. So do the math on that. That would be a painful ride lower. Now, this is the pricing that we saw on 8/31/2015. And this is backwardation. This is a state where the cash is more expensive than the September future, is more expensive, and so on. This is a sign that the market is under extreme duress. And I mean serious duress. All right, and I'm going to talk about something kind of cool here in a second. But when markets are in that kind of shape, this is, when you see this, all of the everything starts to kind of break. Correlations kind of stop moving. Stuff that is normally somewhat reliable can seem far less reliable, far more problematic. And, it can cause all kinds of problems. All right, so, and one thing that's interesting, I'll talk about this a little bit more, but so since they listed the futures in 2004, the S&P's up about, 800 points. That's, all right. So, if all you did was go to cash when VIX futures were in that state of backwardation, do you know how badly you would outperform the market? You would pick up about an extra 1,500 S&P points. There's on that blog, you can see I've actually charted out what it looks like if all you did was go to cash when futures went into backwardation. It's astounding. It is the most reliable indicator. So now, what if you've got a brokerage platform that doesn't have futures? Platforms have futures now, but if they don't, just do this combo. Take the call bid plus the strike price and subtract the put ask, and that will give you the future price. All right, very simple. It's called a combo. All right, so now, size. This means that they cannot be exercised early. They have a unique settlement process, and the VIX futures and the options both have a unique settlement process based on VIX-MO, which is the old way of calculating VIX, and not on VIX itself, but the two are basically the same calculation. At 30 days to expiration, VIX futures typically have a beta of about 0.5 to the VIX. So if the VIX is up $2, a VIX future will typically be up 1 if it has 30 days to expire. As time passes, that beta increases. Right now, September has about 5 days to expire. It is correlating to the VIX index at about 0.7. So there you have it again. There's that curve. All right. And that is a futures curve. And what's been interesting about this curve is that we've seen September is actually about the exact same spot that it was on August 31st. What's interesting is October, all the back end of the curve has lifted. So this curve is much flatter, but it's not because the September futures dropped. All right, so there's that curve again. There's that backwardation. All right. So VIX futures. All right, so now we're going to actually put the pedal to the metal. The most successful, they trade out 8 months. Each month trades independently. All right, so you can't do, there are people that do like different types of calendar spreads on S&P 500 trying to play the role. You cannot do that in VIX. It's a lot more like trading grains than it is like trading an equity. They've listed weekly futures, and again, they're in contango about 80% of the time. So there are people who is making a living doing calendar spreads in VIX, riding the curve lower. So VIX futures contangoed 80% of the time, and I actually really like them as a hedge against a long portfolio when things go crazy. One of the things that I think actually works better than going to cash is hedging off my market risk Um, again, come back to me on that one, Jennifer, at the end. I like to use VIX as a hedge because it's actually, I think, especially in crisis, I think the VIX futures do a better job of protecting downside while allowing for upside than cash or using futures to hedge off beta risk. So VIX options, all right, again, also most successful option product in the last 20 years. Each month trades independently, again. So the underlying future on VIX options is the VIX future. It is not the cash. Every week I get an email from somebody saying, hey, I bought these VIX calls, and VIX went up and I didn't make any money. All right, and that's because the underlying maybe didn't move. All right. Now they're gonna list weekly options, which are going to be awesome on October 8th. I cannot wait for those. I think there's going to be a ton of money to be made in those. And VIX options are a great hedge if you know how to do it, but it's tricky. All right, VIX is, I think it is how I make almost all of my money, but it is also the most difficult to grapple your head around. So they're super liquid, all right? They trade hybrid and open outcry, and markets are tight. They're typically a nickel or a dime wide. So like here's this might be tough to read, but there are days where it trades millions and millions of contracts. So you can get in and out and trade everything you want to trade on it. Do not worry. All right, so now let's talk about VIX option volatility. So the VIX of VIX options is called the VVIX. All right, and it can often seem very low relative to VIX, but that's because it's based on the futures. Futures have significantly lower volatility than the cash index. All right, so take a look here. All right, so VVIX can trade as low as the 60s, and it can trade as high as 200 when we're in a panic. So think about that. We saw VIX double in 4 days. Guess what happened to VVIX? Where do you think VVIX was trading when the VIX was doubling itself in 4 days? Well, the VIX actually didn't even fully double themselves. They increased by about 80%. Volatility went to over 200%, which is nuts. So, take a look at this. I mean, intraday, when vol was exploding, VVIX got over 230%. Just absolutely bananas nutty. And you can see, here's VVIX absolutely exploding. Now, it will normalize. And right now, it's been trading about 130. And that's actually kind of the area that, and this is why you can't have what's called a recency bias. All right. 130, there's been a lot of people that were trading that as an indicator that, volatility might be coming to an end. And then VVIX and VIX totally knocked the socks off. We all know what a recency bias is. I'm going to talk about that. All right. Unlike VIX, relative to SPX, VIX and VVIX can be correlated. So they actually will move together. All right. So when VIX is rallying, VVIX is typically going a lot higher. All right. especially when VIX is moving from below its mean back toward its mean. When VIX is popping and VVIX is not, so when you see VIX exploding higher, but VVIX is not, that's telling you the smart paper, the sharp paper, thinks that VIX is done moving. So here's kind of how VIX have moved together. And you can see those peaks definitely correspond. And VVIX actually falls off quicker than VIX does. It is actually a decent indicator of future VIX relaxing. And that's why with VVIX staying around 130, I'm still not a believer that any of this is over. And I'll tell you guys at the end how I know stuff's over. All right, so now term structure. So we're going through how all the structure of these options are. All right. So unlike many equity products, typically near month implied volatility is higher than the further months out. This is partially because each month has its own underlying and because there is a delta in the future movement due to the premium cushion. So there's that contango. So you see how there's a big premium cushion in May? So May's trading about $3 over, whereas October's only trading 35 cents over. Well, and then here's that same thing. You've got that crazy, you've got a premium cushion moving the other way. All right, so each option spread trades versus the future that expires in the same months. So you can't do calendar spreads in VIX very well unless you know what you're doing and they're not cross-margined usually. You know how you buy a calendar spread in S&P 500 or Apple or GE and they'll cross-margin them. You do not get cross-margining for VIX calendar spreads. So we can see calendar spreads absolutely explode. So because VIX and options have different underlyings, it is entirely possible for a long calendar. So think about this. In Apple, imagine if you could sell an Apple 130 call and buy that expires next week and buy an Apple 130 call that expires in 3 weeks and collect a credit. That sounds odd, right? All right. So the key is that you have to understand that is normal in VIX. So if you look back, think about this. Right now, if I were to do a 25 calendar on this chart, a September-October 25 call spread, well, that 25 call in September is at the money. That 25 call in October is $2.50 out of the money. So it's just not the same trade. So that's why those volatilities can be so different. And the back months are in the 60s, and the front months usually 100, 90 to 100, or higher. Sigma is another word for volatility. And we're going to talk about how all of these things are being webbed together for a reason. All right. Normally, indexes have what's called a backward skew, sometimes called an investment skew. So you buy puts and sell calls to create a collar, caused primarily by hedging activities. Well, think about this. People are afraid of the VIX going up, not going down. So VIX options, all right, have All right, so now, again, recall, VIX options at the money strike is not the cash VIX level, but the futures on that specific date. 25, 22, 22, so 2205. That creates where the at the money is. So now let's actually talk how to trade long VIX when we're in a contango environment, which is almost all the time. So I think volatility is going to go higher. All right, but we've just talked about the fact that there's that cushion when we're in a contango. And VIX can go up, but you don't make money. It almost creates what I like to call kind of a second negative theta. So if you buy a call on VIX, you've got you have the decay of the future falling to the cash. So, there's already a headwind to owning an option. Why create two headwinds? Does that make sense? So the way to do it is to take advantage of that favorable forward skew. Buy call spreads if you think the VIX is going to go higher. Or do a back spread, but I'm not teaching back spreads today. You think the VIX is going higher in the very near term, buy a call spread. When using options to trade a higher VIX, typically the most favorable call is one that is slightly in the money or at the money. All right? And even more favorable trade is that call debit spread. So buy a call that is at the money relative to the future. And then sell one that's out of the money and create that favorable vertical. So take a look at this call vertical. All right? So with the VIX trading 14.25, I could buy an October 17.22 call spread for well under 40 cents. If I hit the bid and if I lifted the offer and hit the bid, I could buy it for 35 cents. Now I think you could probably do it for 30. So I'm betting 30 cents on that call spread, 35 cents, and against it I can make $4.60. And really all I need is a little move, and that 35-cent call spread could go to $1 fast. So, the nice thing is, yeah, you pay 30 cents, and, you may take it off at 15 cents or 20 cents as a loser, or you'll make $1 or more. So you don't need many of these to work because the payout ratio is so favorable if you're right. They can also be a call spread like this can also be a great hedge against all of you that like to be short UVXY or short VXX or long XIV. Short puts. Now, here's the thing to understand. So we've seen the VIX get into the 80s, and the theory is that to about 180. Michelle asked me at the end. That's another great question. So the VIX is traded as high as 180, theoretically. It's only traded below 10 on 9 separate days. Isn't that incredible? The VIX has only been below 10 on 9 occasions. And a VIX future has never gotten there. Lowest VIX future settlement is around, I believe, 12. So, VIX put selling has a positive expectancy when VIX is low. I'm going to teach you a better trade, actually, for when VIX is low. So I like selling puts in VIX, although there's a trade I like better that I'm going to show you. You know, using short puts to finance that call spread can be a really effective way to trade. There you go. Now, this is where a lot of people make a lot of money, myself included. While a trader usually has contango in his or her face when trading from the long side, one typically has the wind at their back when trading from the short side. This makes outright puts an extremely favorable trade. And further out of the money put, the put is, the lower the implied volatility is. So I like owning long puts on VIX. It can pay pretty well. All right. In a falling or stable environment, long puts can pay. So I also like doing verticals, but what's interesting is notice how my OX 1722 call spread same price as a 2-point vertical. Like if I want to do the 1412 put spread, that costs about the same much as my big call spread. It's pretty crazy. So now playing pops. So here's a big VIX pop from 12/28/21. Trade I like to do is a 1x2 call spread. That's an effective trade right now. I do different iterations on that using things like broken wing butterflies. So what I might do is I might trade the 21. I might try and buy the 21 calls for $2.90 or so. And against it, I'll sell the 26 calls at $1.50 or $1.55, maybe more. And I'll sell 2 26 calls for every 1 call I buy at the 21 strike. So I do 155 and I pay 2.90 once. So I collect 20 cents on the spread. And unless that VIX settles above 31, I'm going to have trouble losing. And here you go. The world doesn't end. Congress comes to an agreement. And now my 21 calls are worth 70 cents. And my 26 calls are worth 30. So something I collected 20 cents, selling back at 10 cents. You like collecting money on both sides of a trade? I know I do. So now the trade that I like in a low environment, because remember that the VIX has a floor, is that same 1x2. You know, I'll buy one of the, and this was November of last year. So if I bought one of the November of last year's for like 30, and I sold the 12.5, this is a trade I had on, I collect a dime. Well, now what I like about this is look at the chart. So if VIX keeps going up, you know, or if it goes up, I keep my money. But if it drops and time passes, I can really do well on this trade. All right, on my 1x2 at 12.5, I make $50 plus the credit if it settles 12.5. So that would be I make $60 a spread on something that I view as having almost no downside risk. It has some. Obviously, you'd need the VIX to somehow settle below 1190, something I don't think it's ever done. All right, now lastly, we'll talk hedging. So VIX is actually, as many of you know, a hedging vehicle. So the calculation is directly related to how a over-the-counter trade called a variance swap trades. So a variance swap is an over-the-counter trade where each side bets on how much the market is going to move. While there are many circumstances that SPX or SPY are better at hedging, I like using VIX options, and here's why. If one could be using a near-term hedge, the VIX could potentially work better. And the key is the VIX has a sticky strike. So think about this. At the beginning of the year, in May, or well, not May. Let me say in March, the S&P was about 2,000. The VIX was about 13. In July, the S&P was about 2,100 and the VIX was about 13. So you get what I mean by sticky strike? The VIX has that floor, so it'll hold a level, even if the underlying rallies at a certain point. That's why it doesn't correlate. That's why it doesn't correlate completely negatively. So if the market stays around where it is, it might be more of a wash. It's less of a good trade if the S&P takes a quick drop. But what if the S&P explodes? So, let's look at kind of how a July hedge in October works. So, what is the major issue of using VIX as a hedge? And that's that backwardation. So if I buy a VIX $18 call expiring in October, it's highly unlikely the VIX will be able to move far enough out of the money that the strike no longer hedges. So how does it compare to a sharp move in the SPX? Let's look. All right. So we've got that sticky strike. All right. So if I buy a VIX $18 call expiring in May, it's highly unlikely the VIX will be able to move far enough out of the money that the strike no longer hedges. So that's the key. So if we're in May and I buy a long-term VIX, like an October 18 call, all right, that October 18 call, 6 months from now, will still be valuable. Whereas, think about this, the SPX moved from 1950 to 2125, and you hedged with a 1900 call. You got no help in July, and you really didn't get any real help in this August crash until really August. You'd already made a huge move lower. You'd given up all the gains for the year. So think about this. So we're just going to look at kind of the peak of the way things kind of looked. All right. So think about this on July 14th. All right. The October futures around 1685. SPX was 2104. So how did they move on that AUG vol explosion? All right, so I forget what exact date, but at one point that OX 16 call we bought for $2.50 expands to $8.50. So it goes up by and is now more than that. It's about 10. All right, and even with basically now being an at the money option again, it was only worth about $86. So if you spent the same amount of dollars hedging, you made way more money with your VIX hedge. So now, think about this. Here's what I want to say about a smart hedge. Recall that I explained how to trade VIX long from a speculative side. Why in the world would I treat a hedge any different? Use call spreads. Right? When the VIX is cheap, buy a call spread, sit and wait. It will work. Now, the other alternative is actually wait for the VIX to go crazy and then buy VXX. So in summary, VIX options are unique. IV and VIX are correlated. Bear and bull plays have different structures. Each has their own underlying, and play the spikes. So now here's my special offer. This is only for candle people. All right, I sold this for way more at the web. I did a very similar webinar last week, and I sold this for more than that, like an extra $50 more ahead. So this Saturday, I'm doing 4 hours with Andrew, my partner, of VIX and volatility ETN trading. So we're going to teach you about UVXY, SPXY, VXX, VIX options, VIX futures. Really super, super, super meaty stuff. All right. Now, we normally charge $247. I have it discounted to $147, but because Steve is Steve and Steve's the man, we're going to do, if you use coupon code CANDLE70, when you sign up with the link in the forum there, use that link so that we know that you bought it through Steve's forum, although I'll know when I see CANDLE70 as well. It will be recorded. It is yours to keep after it's recorded. And so instead of 147, it's just 77. All right, so think about that. It's 4 hours, $77, $18 an hour. You know, that's what I pay my lawnmower guy. All right, that's what I pay. There's a kid down the block. I have him come over, and he helps me with yard work, and he helps me with stuff like that. When I've got a bunch of shrubbery to remove, I pay him $20 an hour. All right, you're getting stuff that is going to be super actionable to you, super actionable, and you're paying less than $20 an hour. All right, so now questions. I know we had a few. I know we had a few questions earlier. How does the Fed, so one of the things with VIX is that it tries to be anticipatory. So even if the S&P itself isn't selling off, you typically will see the VIX itself rally into these meetings. You know what does not? All right, VIX futures are typically already pricing some mean reversion. So you see a lot less movement in the VIX futures and thus VIX options than you do in the cash index around these meetings. Does that make sense? Awesome. All right. Any questions? Oh, and if you're not going to buy the course or anything like that, I do want everyone to know this. Never buy VXX or UVXY as a buy and hold. Is with significant time a good strategy when VIX is spiking. It's not a terrible idea. I usually use like an out-of-the-money calendar spread to try and produce some decay. But, one of the things that you'll find more effective, buddy, is that, if you just simply wait for the VIX so if the VIX is spiking, but futures are still in contango, I like that play a lot. But if VIX is spiking and futures are backward, you will have an easier time making money waiting for VIX futures to flatten and then buying that put. Again, you'll have more money selling vol lower, and well, it should. Let me make sure it's active there, folks. Well, all right, I will take one look here, folks, while I'm answering questions. I'm double checking. I understand that. I don't want you guys to not get your promo. Promo code Candle70, correct? Just edit to make sure this works. I'll take a look. Give me a second here, folks. If it doesn't work, tell you what, if it doesn't work, shoot me an email and I'll rebate the difference back. Okay? I'll go in and just do it manually if I need to. Yeah, that is odd, isn't it? You can email me marketoptionpit.com. I will rebate everybody back their $70 that signs up. Give me 2 seconds. I'll go in and manually jimmy it to make it work. No, you won't need to use the code. Yeah, if you've got questions, feel free to email me. All right, sorry about that. So it should just come up as $70 now if you guys go and buy it, I believe. Yeah, nope, still. That's weird. Hmm. Well, I'll have this fixed when this goes out tomorrow, Becky. Don't worry. I don't know why. I do not know why it's not working. I'm usually pretty good with Infusionsoft, and this is annoying. Any other questions? All right, well, I'm glad you all enjoyed it. What is VXX versus XIV? VXX and XIV are inverse of each other. Class is going to be from 8:30 till 8:30 Central till 12:30 Central. It's going to be recorded. So VXX and XIV are inverse of each other. Although actually, if you short both of them, you make money. Think about that. I'm looking. Again, I'm hoping. Yeah, I don't know why it's not working, folks. Like I said, I'll rebate it back tomorrow if you buy it. If not, it will be working in the morning. But like I was saying, I'll rebate back to $70. Okay. Any other questions? I'm glad you enjoyed it. All right, everybody, have a great night.